All right, hello traders. This is James Stanley with StoneX and FOREX.com, hosting the opening bell this week, filling in for Mr. Michael Boutros. And it's a big week. We have the US CPI print on Wednesday, some more US data. We have an RBA rate decision later on tonight. So there's a lot to look at. I want to take this from the perspective of the US dollar. I'm going to look at the dollar in a few different ways in this video. Firstly, to look at a risk disclaimer, I'm going to leave this up for 30 seconds up front. It will also be up for 30 seconds on the back. Please do review that. Pause the video, take more time to review that if you so need. I will be on the other side and we'll start looking at charts. All right, so I wanted to first start off with a look at the economic calendar for this week because this is one of those weeks where things can change, especially in the FX market. We've had a lot of volatility in the dollar yen pair that backed off a bit last week. But again, I think this is the kind of week where things can shift and change very quickly, very dramatically. But we go through the RBA rate decision before we get to anything US related, at least on a high impact basis. That rate decision is later on tonight. The wide expectation here appears to be for a hawkish hold. It's been a really strong start to Q3 ever since the July Open for the Aussie, and I'm going to look at that in this video. It's coming up on a pretty big area of a support turn to resistance. It's holding above the 70 handle for now, but again, I'll look at that here in a moment. But wide expectation for a hawkish hold. This is the big one, the CPI print out of the United States. And notice moderation is expected, 3.4% on a headline basis, 2.5% on a core basis from 2.8. This one's big because this is the last CPI print that we're going to get before the Jackson Hole Economic Symposium. This is where Kevin Warsh is going to be opened up to talk more about the matter. And if I think we look at the overall situation there, it still seems as though markets are harboring the expectation that he may be hawkish. And that's not an expectation that I share. I think that he's at this point wanted to sound hawkish. I think he wants to keep markets on their toes. I think he wants to keep markets away from the spot where they're just automatically expecting the Fed to err on the side of dovishness. But I'm going to get to that as we go through the USD. A little later in the week, we get UK GDP, US PPI. So it's a little bit more definition, but notice the expectation here, again, is for some softening, down to 4.2% from a prior print of 4.7. And then on Friday, a couple of important data pieces, especially given the Atlanta GDP Now estimate that we had most recently. That came in scorching hot. Now it is an estimate. It is a very volatile data point, but it showed at 5.9%. So I think there's going to be a lot of focus on retail consumers to see if that clip of strength holds. And then U of M consumer sentiment to finish off the week later on Friday. Now, for backdrop and context, it's still roughly a coin flip for a rate hike in September. Let me just update this, get the most recent odds. I'd updated it like 10 minutes ago, so it should be about the same. Yeah, 54.1% probability for a hold in September, 45.9% for a 25 bip hike, but it's going out to the end of the year where that plot thickens. It's roughly 80%, 79.3% probability of at least one hike into the end of 2026. And notice after September, there's just two more meetings. So if the Fed is going to hike, then one would think that they would want to start laying the groundwork for it. And for that, I think we are going to need to see some continued strength in inflation. And we've heard so much from multiple Fed speakers. Like most recently, as Lisa Cook last week, it was Paulson before that, John Williams before that, all of which opined that if inflation seems to be coming in strong, continued strength, then there's a lean where they're going to have to hike rates. And the story that they're giving is that they really want to avoid a 2021 transitory type of debacle. Now, I still think that a lot of the FX market is contingent and hinging on this setup, on this backdrop. And I know that gets some agreement across circles, some disagreement across others, but when you look at the built-in carry trade here, let me go to a chart that's a little bit cleaner. If you look at the built-in carry trade here, dollar yen is still up about 52%, a little more now. It's up 53.54% from those early 2021 values. That's just a massive, gargantuan move in a major currency pair. So significant yen weakness, significant dollar strength. But the reality is this doesn't just price in on the basis of fundamentals. Like, this isn't just where banks say it should be. This is based on supply and demand. So there's been significant demand in this pair over the past 5 years that has built that 53.54% allocation rally. So when we get something that whiffs of change, this crowded trade could be a crowded exit very, very quickly, and that could lead to some extreme volatility, to the point where when we get weakness in the dollar yen pair, that could simply and easily equate to weakness across the dollar spectrum. As a case in point, last week, or 2 weeks ago rather, around the Fed and BOJ, this was the largest weekly sell-off in the dollar since January. And it was largely driven by unwind in that dollar yen carry trade. And that's to the point where it could even push up a larger constituent like Eurodollar. Eurodollar's breakout, there wasn't a lot of great data out of the Eurozone that week, but pretty significant dollar weakness that helped to push USD weakness across the board, even in Eurodollar. I got this at a big area of resistance, but we're going to parse through that. So let's just start off with the dollar and work our way down. So first and foremost, in the USD, I have this at a pretty big spot of support, a very familiar spot of support, which I think shows very clearly right here. This was a gap from back in April. It's come in as resistance and then support. We're testing it again for support right now. You can see where we had that pretty massive sell-off on the BOJ intervention 2 weeks ago. Since then, it's largely stalled. And again, I think this is rooting from and emanating from that dollar yen backdrop. But for now, it looks like there's an open door for a pullback to test. But there has been a penchant for sellers to come in at these lower highs. Now, if you draw this up short term, there is a falling wedge in here. Falling wedges are bullish reversal formations. But for those formations to come to fruition, you first need to see a break of topside resistance. And then even if we do break topside resistance, there's a really big zone up here around 100 spot 21 to 100 spot 40. So I'd be careful of any long-term bullish prognoses on USD right now. Short term, it does appear as though there's an open door for bulls to take a run at a pullback. But maybe that's something that works as we get closer to that CPI report, that CPI print. For downside, I think if you look at this from this basis, you look at this from the weekly chart, it's largely been range bound ever since we had the sell-off into last year's Q2 open. And this area, that 121 to 140 area, that'd be an ideal spot for bears to come in to reject a bounce. And again, if you look at what was rooting behind this, a lot of that was built on the basis of that dollar yen trade being pushed by rate expectations. And so it really combines a lot of themes for this week. But USD, short-term bullish backdrop, longer term, I still think it's a bearish backdrop, because I don't think the Fed is going to come to the table with as many hikes as markets are pricing in. I think markets are just a little bit spooked, a little bit freaked out. New Fed chair, he's removing some of the communication. He's taken some of the lean away from forward guidance. He wants markets to display those animal spirits, if you will. And I think that's market participants responding in the way that they do to uncertainty. They abhor it, and so they usually respond to it with risk aversion. But that's USD. Dollar yen, again, I think this is the main driver, and the reason is because of just how loaded up that carry trade is. Now, I've done a number of videos on this over the past couple of weeks, and when we had the initial sell-off 2 weeks ago, I did a video going into that weekend, and as I said then, I didn't think this was a very compelling. This wasn't a very compelling short from 155, and multiple reasons for that. Give me 1 second, sorry. There we go. just had to get extra batteries. I didn't think it was a compelling short because it's not like we were going to get an intervention at 155, right? And as we get closer to that 160 handle, that math can change. 164 is the line in the sand that we've had so far. But I think there's an analog in here. For that, we got to go back to 2022. So interventions themselves aren't great for reversals. They can give a pullback, but for the reversal, you need something that is going to shock longs that are holding this position to the point where they want to close out of a trade. And a perfect example back in 2022. Like if you think about it in 2022, this is right around the time that stocks were bottoming, by the way, after the Fed's rate hike run that year when they were going in 75 bip clips. But the BOJ initially tried to stop the roll at around 145, threatening intervention. They did even intervene here, but it's really kind of weak. Buyers just loaded back up, and the reason is because the long-term bias is still bullish, and markets weren't really afraid that the BOJ was going to drop the hammer to the point where an actual reversal was going to show up. So, again, we get up to 145 where the BOJ is drawing that line in the sand, not all that attractive. We get down to a 140, pretty attractive risk reward. Bulls load back up to the point where they test. And notice once we get above that high right here, that prior swing high that was like 145.86, it blasts off. Now, why does that blast off? There's a couple of reasons. One, you probably got some stops on short positions that are setting right there. Basically traders saying, well, they stepped in once, they'll step in again. And if they don't, I want to get out before this breaks out against me and causes a pretty sizable loss. So you got some stop orders in there. Stops on shorts or buy to cover. That's more demand. That's why this thing shoots up as soon as that top gets popped. But then notice it goes right up to the next big figure, 150. We had one daily close above 150, and then right here's where the BOJ had to scream uncle. We run up to 150, 195. And that ultimately is where the BOJ stepped in to intervene again. Now, that was a pretty bloody Friday. I remember that one really well. But what we're seeing here is kind of like what we're seeing right now, where when we get down to 145, it's a pretty compelling value opportunity. BOJ intervened at 150, 195. They just wanted to stop the bleeding. It's not like they're going to jump back in because interventions on the BOJ side, it's not like it's a great thing. They got to burn finite capital reserves, usually entailing selling U.S. Treasuries, which is one way that they hold a lot of those reserves, selling U.S. Treasuries to go out into the market and to buy the yen, even though their own monetary policy is encouraging the opposite. Another dip down to 145. And notice we're getting closer to those prior highs, closer to that 150 level, but we did not cross that line in the sand because that was the theoretical spot the BOJ was going to come in to cap this. What ultimately compelled the reversal, and that's why this all matters for right now, was a US CPI print. Now, this is a story of expectations because if you look at the way that CPI came in, it was not good. US headline CPI was at 7.1%, core was at 6.3%. So it's not like the Fed was in a spot where they were going to start cutting rates all of a sudden. But it was below the prior month's print. It was below the expected. It had given hope that the Fed had gotten a control of inflation after those 75 bip hikes that they had to do earlier in the summer. And now all of a sudden, longs were encouraged to close this off. And that's why this broke down with aggression. That's why it continued to break down for the next 2 months as you saw a crowded trade into a crowded unwind. And, and keep in mind, the carry was still positive on the long side of the pair throughout. But carry, fundamentals, rollover, these things aren't the only items that drive prices. The only thing that actually drives prices is legitimate buying and selling, which can be coerced by those factors, but a crowded trade into a crowded exit. And there were more episodes of that. Like we got back up to that 150, 195 level. Notice there was a lot of posturing in 2023. I mean, so a pretty massive rally. But again, that was a US CPI print, Tuesday, November 14th. Once again, compelled a pretty stunning reversal, pullback type of setup as longs got shaken out. And why are longs getting shaken out here? There's multiple reasons. But notice along the way as these lows get hit, it's almost like the move accelerates. And it's kind of the opposite of what I was talking about right here, that high. where you have stops on longs that are trailing on these swing lows. And so when those swing lows get taken out, there's more supply in the market, price dips down and then runs back up and then dips down. Again, notice when those slows get taken out, it almost like accelerates down further. We got below 145 and notice it was a splash. Stops getting run. But there's another element going on here. The actual underpinning of the carry trade is institutional in nature. Like if you run a hedge fund, your job is to look for risk-adjusted rate of return. So if you could go to a Japanese bank and get a loan at 1 or 2% when Japanese bank rates are at or near zero, and then you could go to another economy like the US and invest it elsewhere and get a higher rate of return, well, that's a spread. Pretty low risk spread on a relative basis. Now, the problem is that you have currency risk because you're getting that loan in Japanese yen. And if the yen is weakening dramatically against the dollar and you have to close that trade and you were in the yen the whole time, well, then you could end up watching the entire benefit of that spread go up in smoke. So what are you going to do? You're a hedge fund. You're going to hedge that risk. Hedge that risk by selling into the marketplace, buying dollars. And that's just another force of upward pressure on the move. But when it looks obvious that change is afoot, pretty convenient time to release that hedge. And that's kind of like what happened back here in July of 2011. Because, if you look at this story and the way that it had built, the carry remained positive throughout. Items of good US data pointed to less probability of rate cuts in 2023, 2024. That's when the Fed started forecasting that they would cut rates, but this is kind of like markets calling their bluff. April 10th was a big day. That was a US CPI print. Came out above expected. It dashed water on the hopes that the Fed would legitimately be able to cut rates. Notice we get one of those big breakouts. Same thing, 150, 195, a bunch of stops setting above it. It's like rocket fuel for longs. And we go straight up to 160. 160, BOJ intervenes again, fails. Gave us like a week of weakness and a pullback to 150, 195. Same thing, you got longs getting shaken out. Support shows a prior resistance, we go right back up. But right in here, the BOJ had waited for that next intervention. It was a CPI print. Again, notice there's a theme in here. It's US CPI prints that are doing the driving on this pair because the conduit is rate expectations into carry. Thursday, July 11th, US CPI print. This one comes out below expected. Finally, markets get the needed data that they were looking for to justify FOMC rate cuts. Also, in the morning, the BOJ intervened. And so you had multiple forces pushing that pullback that quickly turned into a reversal. But along the way, you had a bit of pandemonium that piped up. Now, below expected CPI, higher probability of the Fed cutting rates. Fed ultimately cut 50 bips in September. You would think that would help tech stocks. No, it didn't. Again, fundamentals aren't a perfect push point for price. When you have a carry trade, it's essentially a form of global leverage. Funds and institutions could borrow cheaply in Japan, invest it elsewhere, try to pocket the spread. That leverage is going to seep into all kinds of areas of the market. Now, initially, it's probably going to hit rates to go for the lowest risk profile, but eventually, once rates are relatively low, there's not a lot of juice there. They're going to look for other things like that high-flying AI tech trade. And so that morning, Thursday, July 11th, we actually had a bearish engulf in NASDAQ 100 futures. And that lasted all the way until the morning of August 5th. Here, I can show you. 1 second. Beautiful the way those interrelationships will often work, but right in here, Thursday, July 11th, bearish engulf goes spiraling out of control. That morning of August 5th, we had the third highest ever spike in the VIX index. Third highest ever, behind only the financial collapse and COVID. And it was just dollar yen carry unwind. Now, eventually cooler heads prevailed. There was some lag in the dollar yen trade and the NASDAQ trade. NASDAQ bottomed for that iteration August 5th right here. NASDAQ bounced. Dollar yen, NASDAQ bounced more aggressively, even though dollar yen bounced as well. Dollar yen ultimately bottomed right here, perhaps paradoxically, 2 days before the Fed started cutting rates. And the Fed cut 50 bips here. But notice, again, this is markets looking around the next corner, saying inflation's high, Fed's cutting. These cuts aren't going to last for long. Rates ultimately are going to go higher. And this is one of the things that pop treasury yields. But it only took a few months, and that's like an 1,800 pip rally in dollar yen. Where we're at today, well, that crowded trade has just continued to get more and more crowded. At a 155, it doesn't make sense for the BOJ to jump in and intervene. At a 160, perhaps makes a little bit more sense. I think as an absolute, the line in the sand is getting looked at as like around a 164, 165. But to draw the parallel, 155 now seems as though 145 back in November of 2022. So last week we had that NFP report, really bad NFP report, really aggressive sell-off. But again, there's not a lot of continuation in here because that branch has already been shaken a bit. So the big question now is what happens at 160, and I think that puts a lot of pressure, a lot of onus, well, on this, into this, and then into this. If we end up with a higher than expected US CPI print, then I think we're going to see September rate hike odds push up. And I think that's more reason for this to go up and test a 160 or a 161 or a 162. And that's where both the Bank of Japan and the US Treasury Department are going to be put on the hot seat. Whether it's an actual intervention or a threat of an intervention, either. But shorter term, this could still present compelling pullback opportunity or setups. But that 160 area is where things start to get a bit more daunting, a bit more vulnerable. And it's very similar to the look that I had on USD just a moment ago. All right, we got 8 minutes left, so let's work around. It's rare that the euro is going to be the dog getting wagged by the tail. I got this at a really big zone. This is one I've been following for a while. Similar area of prior support turned resistance, 115.76 to 116.13. That ultimately has capped the high so far this week. You look at this 4-hour, it's still a bullish setup. We just had a fresh higher high, recent series of higher lows, and there's been some decent higher low defense, 115 to 115.15. So short term, I think this could run counter nicely to that USD setup, whereas USD looks like short term bullish, long term bearish. If we are going to see a larger dollar recovery, this is something that questions that 115 area in euro dollar, and then this area are like 114.55 to 114.69. Next major zone that I have up is like 116.70 to 116.86. We get above that, it's going to look like euro bulls are taking advantage of the situation again. But notice we had this falling wedge that had built going into the Fed. It broke out with gusto. And again, a lot of that help, a lot of that lift came from that dollar yen carry unwind. Right now, there's a rising wedge that's building. Bulls just simply aren't keeping the pace on higher highs, while they're still pretty aggressive around these higher lows. Yeah, it doesn't play nicely there, but there we go. Let's tighten that up. Rising wedge, bearish reversal formation, but again, to give this any life, it really, I think, needs to put in a 115 break. The one that I like a bit better for USD weakness is this one. It's cable. And I have this retesting a really big area at 135. When we were going into the Fed a couple weeks ago, I was looking at this at a very similar backdrop as euro dollar, where we had the falling wedge. A strong breakout showed after the Fed, higher highs, higher lows, and we went right back up to that 135 level. The problem is longer term, this pair has really struggled to hold above 135. I mean, there has been some iterations above 135, like all the way back in 2021 when the dollar was really weak, when the Fed was avoiding the inflation topic, saying it was supply chain transitory related. Since then, we've had some tests above, but very few rallies above. So, on a technical basis, I got it there. It's showing an ascending triangle-like type of backdrop. We have these higher lows to go with horizontal resistance. I just have a really difficult time getting bulled up too far beyond 135. But there is a door for a breakout setup right now. You look, and there's even some strong short-term structure to justify continued strength, support prior resistance, 135 retest. Again, the technical setup is there. The more difficult argument is that long-term challenge at the 135 handle in cable. All right, let's go to Aussie. So the Australian dollar is not in the DXY basket, and really that's just statement to guess how antiquated that DXY composition is. It was created in the 70s. When it was created, it was a different world. We didn't have a euro, so we had a smattering of European currencies that all conglomerated when the euro came to inception, and that's why it's 57.6% euro. So DXY is largely an anti-euro. If you look at the math, 13.6% Japanese yen, and those are the two largest components. Aussie's not in there at all, but it does swing well with dollar themes. And as a case in point, right here, June 17th, that was the FOMC rate decision. That was Warsh's first rate decision. That was when he kind of took everybody by surprise. It sounded as hawkish as he did. And that's what kick-fired the sell-off in Aussie that ultimately bottomed right here on the last day of Q2. So far in Q3, it's been a very different type of tune. But, just notice the way that this has swung so far this year, right? It's when you get these grouping of wicks that you want to start looking at the possibility of a swing, right? Like it's very much been a tug of war as this thing has been trying to chew its way back. Tough area to try to get long right now. I think where the possible opportunity on this is there's such a wide expectation for a hawkish hold is that, and considering USD as well, if we do get maybe a little bit of softness in the way that the RBA sounds, maybe looking for a pullback and then seeing if buyers come in to defend a retest of that 70 handle. So we had like this grouping of wicks right here around 70.21, a couple of underside wicks right here that led into a bounce. If we get down there, ideally what you want to see is bullish anticipation that will disallow for a retest of the 70 handle. Even if we get a 70 retest, I think it can still be justified for bullish trend continuation. It's just a tough spot to try to chase this move after we've had such a streak of gains, following that pretty dizzying pullback that it showed. So, this is one that I'd want to keep on the side for USD weakness at this point. For USD strength, I'm going to go over here to dollar CAD, where we had a pretty significant break of a really big level last week. And it's right at that 140 spot. You look at that 140 spot, and this is a level that's had a lot of history in dollar CAD, and not even just recent history, long-term history. 140 was setting the low for a few weeks, and then we finally had sellers take a step forward on Friday. So a couple of different things. If you want to get bearish on this, I think chasing it right now is challenging. That 139.20-ish area, it was a group of swing highs back here in January, held the highs here in April. It's now in a support. Tough area to chase this lower. If you are looking to try to load up on shorts, that 140 area is a pretty ideal area to look for lower high resistance. And if you think about a cross-border exchange rate like dollar CAD, I think it makes sense as to why these big figures, these psychological levels, have a tendency to produce inflections. And it's because a lot of the trade and capital flows that operate off of this are from non-speculators. There's a lot of businesses that work off of this exchange rate, say like a car dealer, for instance, that will buy and sell cars in Canada and the US. If you have the dollar spot really strong, that's that's indication of how you want to be adjusting your business. If you got the dollar spot really weak, that's again something that's going to adjust the way that you're doing business. But it's those psychological levels that will stick out to those types of market participants. Thus, again, you look at this long term, and there's a tendency for like 145, extremely rich USD, extremely weak Canadian dollars. Not a bad time to be buying your cars in Canada, selling them in the US. You get a really weak spot in dollar CAD, not a bad time to be buying your cars in the US, selling them in Canada, right? That's going to have a lot of influence in how these cross-border businesses operate. But 140, if we, again, you can even see this on a short-term basis. We dip below, compelling value opportunity. Took a little while for it to finally chew through. If we pop back up on a 140 print, so like let's say if this inflation comes in hot, we see these rate hike odds pump up a bit for September, then that's a pretty compelling area to look for a fade if looking for USD weakness. If looking for USD strength, I think the item of attraction here is to see if bulls can retake that 140 handle. So like short term, there's a bounce setup that could work into 140. I'd be cautious at putting targets all the way up at the big figure. Maybe looking for something a little bit inside of that for an initial topside target. But if they can retake 140, it's going to look as though bears had failed and then bulls are back in the driver's seat. And there's a couple of recent iterations that we could see where something similar played out like that, right? Where you get that first test above 140 and then it sweeps back below. It takes time for those levels to finally give way. Rarely is it going to be a clean cut and dry break and go. But that, my friends, is what I have for this week. That's what I'm looking at as we go into this week. There is a lot of intrigue on this calendar, starting with the RBA tonight for the high impact events. But really, it's about US CPI, and in turn, it's about dollar yen. So that, my friends, is what I have for today. Thank you for your time, and as always, happy trading, ladies and gentlemen.